everybody. Welcome back to the Blockware Intelligence Podcast. Hope you're all doing well. Before we get into the show, let me tell you a little bit about our sponsor, FTX US. FTX US, one of the largest crypto companies in the United States, is the safest, most regulated way to buy and sell Bitcoin, Ethereum, and other digital assets. With FTX, you can trade crypto with up to 85% lower fees than top competitors. There are no fixed minimum fees, no ACH transaction fees, and no withdrawal fees. FTX has also recently announced their stocks beta rolling out to US customers to enable crypto, stocks, and NFT trading in one interface. This includes hundreds of US exchange-listed securities, including common stocks and ETFs, and an integrated experience within the existing FTX US cryptocurrency trading application. Use promo code Blockware1 or go to ftx.blockwareintelligence.com to earn free crypto on every trade over $10. Again, that's Blockware1 or go to ftx.blockwareintelligence.com to get started today. Now let's get into the show. Hey everybody, welcome back to the Blockware Intelligence Podcast. Today I have a very special guest, Mr. James Lavish. James has become somewhat of a good friend of mine. We met in Miami at the Bitcoin conference. James is a great guy. He's got a really cool background. And on top of that, of course, he's extremely brilliant and has an extensive background in the financial landscape. James, thank you so much for hopping on the show and taking the time out of your day to come join us on the podcast today.
Yeah, of course. I'm honored to be here. It's fun to watch all of you guys just, in this Bitcoin space. The intelligence here is incredible. I don't care how old or young you are. There's some awesome minds here. So I appreciate you having me, and I always enjoy talking to you, Will.
Sure, thanks. How do you think the kind of landscape of I guess networking and just all around just connectivity between all the individuals in this ecosystem compares to those in traditional finance? It just seems like, I mean, again, I don't have any traditional finance background, but it seems like everyone is extremely willing to just share things because this is such an infantile market. And I've never met anyone that I will say I strongly disliked. It just seems like everyone's super excited just to push this ecosystem forward. But I'm curious your thoughts on how that compares to the traditional finance world.
Yeah, that's a good question. I've never been asked that before. And to be honest, the traditional investment world, at least in the institutional world, it's pretty difficult to get in, Will. You have to kind of know somebody, or you have to have gone to Stanford or Harvard and gotten your MBA. Otherwise, you have to be introduced to somebody, meet them, kind of prove yourself that you're somebody they would want to work with. You have to have come super highly recommended. And then people will start talking to you about whether it's hiring you or working with you or consulting or whatever it is. But in this world, it's unbelievable how generous everybody is. I mean, I jumped onto Twitter, in September, October of last year, and I've met so many people. And between people like you and Greg Foss and Larry Lepard, Jeff Booth, there's just some absolutely incredible people in this space, and they're super generous. Like you said, they're always willing to talk through their ideas or their experience and share that with you, which is awesome. And that I like doing that. I like taking what I've had in my past, my experience, my institutional investing knowledge, and bringing it here to give people a little bit of a different lens, maybe, to see things through. It's not always the right lens, but it's definitely something that I think is important to the space. So I'm just thankful that it's been super easy to meet everybody. So definitely, it's a completely different world.
Well, let me ask you this first. I guess to kind of give our audience some context, can you just walk us through high level kind of what your background was, how you got into finance? I don't want to, have you repeat yourself too much because I know you've kind of ran through this on other podcasts, but at least kind of to just give us context and how you got into the financial landscape. You're part of a hedge fund, all those kinds of things.
Yeah, I mean, we'll do the really fast recap for people who haven't heard them, but I was a hockey player in college. I was playing hockey at Yale, and I was good enough and doing well enough that my plan was to go to play NHL right after college. And we don't have scholarships in the Ivy League for sports, so I was paying my own way. But the trade-off is I was getting a great education, and so I knew that. Fortunately, my senior year, I got hurt, and it was pretty much a career-ending injury, and I was left with no real plan and no identity. And so I wasn't sure what I wanted to do. I was in New York. The team that I tried out with, the New York Rangers, they went on to win the Stanley Cup, and I was sleeping on friends' sofas trying to figure out what to do and how to pay my bills. So, I ended up meeting some people and figuring out, well, I'm pretty good at math, and what do you do if you don't know what you're going to do, but you've come out of a school like that? You go to Wall Street, right? But I didn't want to become an investment banker. I thought that's not really where I want to spend my time, putting together deals. And really, when you're young, you're just working 100+ hours a week, putting together pitch books and deal books for mergers and acquisitions, pretty much. But I found this world of trading, institutional trading and investing. And my first job, I got hired by a British investment bank to trade something called ADR arbitrage, which is trading foreign securities on the New York Stock Exchange. And you can buy and sell them and translate them using the currency and a basket of securities and the stamp tax and all that. And you can arbitrage between one exchange and the other. Back then, we didn't have spreadsheets, so whoever could grab their calculator and do it the fastest, we didn't even have iPhones, right? So it was like a little calculator, just as quickly as you can, and you got the trade if you got it fast enough. So, and that was really how I started meeting people in hedge funds. So I don't know how much you know about hedge funds, Will, but back in the early 90s, they weren't really that well respected on the street. They had been drugged through the mud between the LBO world, and then you had the insider trading scandals of Michael Milken and Ivan Boesky. And so after 1987, they weren't really well respected, and people didn't really know what they were doing. But the hedge funds that I was being introduced to were ones that were trying to lower risk of investing. And the way they did that is they hedged out what we call beta risk. So your market risk, the market going up and down, is your beta. You know this, but for the benefit of some of your investors or your listeners. So the beta risk is just the market going up and down. But if you can isolate what you want to capture, that you think that you've found in the market, that there's a discrepancy, there's an inefficiency, you can short out that beta risk. Right. So that's what hedge funds were doing. They were buying and selling securities, hedging out that beta risk. An example would be, buy Citibank, short Bank of America in the same dollar amount. Well, you've shorted out both the market and the banking sector risk, because they'll both go up and down with that risk. But if Citibank is a better company, has better underlying fundamental value than Bank of America, then that spread should close. You're short this and you're long this. So even if they both go down, that spread should close, and Citibank comes up and Bank of America comes down in that ratio, if that makes sense. So that was how I got into it, just understanding that mathematical relationship and being able to do things like that. So
yeah, I think that's super helpful. It's super interesting as well. It's always cool to listen to people who were in the financial world like longer before me, and just hearing about like how inefficient things were. Now like all these spreads are super tight, and like it's really difficult to get into any type of arbitrage type of trading, and especially in the traditional finance world. In crypto, we still have all these like crazy fat spreads that you could arb out, and there's a lot of opportunity there. But in traditional finance, a lot of that's kind of been arbed away over time as the market gets more efficient. So
yeah,
cool.
Well,
I think
it's both.
Go ahead.
It's both the market being, the market got more efficient, but it's also because just structurally interest rates came down so much that if you think about it, you're keying everything off of the risk-free rate, right? Risk-free. So, which we know now, being Bitcoiners, that nothing's risk-free. So, but the point is that as the interest rates came down, that spread that everything's keyed off of lowered. And so it's been very difficult to find any yield anywhere, because if you're going to take on risk, then I mean, if you can make 3, 4, 5% doing something that's slightly riskier than this, then you'll do it. But back then it was, we were trying to make between 9 and 12%. And that's after the early 90s, we were trying to make 12 to 15%. So now that's been collapsed all the way down, and it's really difficult to be profitable if you have something go wrong in your portfolio, because you can't weather that spread blow up will blow up your portfolio if you're not making enough return on each of the individual investments on the way along. So the analogy is you're picking up nickels in front of a steamroller, so.
Yeah, no, that makes a lot of sense. I didn't think about that as well. What do you think the perception from some of these traditional finance entities is of the space, like overall, but most recently with all these blowups? Yeah, I think, look, I have a very small circle of these individuals, especially compared to someone like you, but the few people that I do talk to, I think there's kind of a mix right down the middle of some people approaching this as, yeah, I told you so, this thing's a scam. And then you've got some people that say, hey, look, I'm actually interested in getting involved in this space now, because it seems like, there's a lot of distressed pricing and a lot of forced selling, perhaps some things that are analogous to things that have taken place in traditional finance. Like you look at Three Arrows Capital versus long-term capital management, right? I mean, pretty much the same thing. So like, how would you say the perception from those individuals you speak to has been of the space overall, as well as most recently over the last few months with all these crazy events that have taken place?
Oh, I mean, in the mid 2010s, so like 2015 to 2018, all of it just was considered a scam, a total scam. Like there was just Ponzi scheme after Ponzi scheme. Nothing was differentiated really in my world, for the most part. And then since then, some people have started to understand it. And so you have very few people who really understand the space and understand that Bitcoin's different than everything else. And, they get it. But they come from a traditional mindset, right? So the traditional investing mindset has everything keyed off of again, that risk reward, and everything's looked at as risk assets. So bonds were your safest asset, and anything in equities and beyond is a risk asset, right? So, and crypto was just lumped in with all those risk assets, and people thought of it as technology. And so technology analysts are the ones who were covering it, and technology portfolio managers. And so what you got was very few people who really understand it. And then you have a few people or a bunch of people who think, oh yeah, I'm in the space. I see that there's a lot of, there's a way to create some alpha here in my portfolio because of the volatility, and with assets that are rising in value, volatility is a good thing. And so, but they just started buying anything from Bitcoin, Ethereum, Cardano, Solana, whatever they put in their portfolios, because they kind of saw it all as the same. And they were looking more along the lines of what's the asset and the market value of each of these assets, and where do I think those market values can shake out. And so a lot of them were just making bets. And so that's another chunk. And then the last chunk is just completely, they just completely shut down to it, like don't want to even talk about it. So it's but I think that they're coming around. And when you have firms like Fidelity put out reports like you and I have talked about before, that's really important to have somebody in the traditional space, like one of the top 5 investment managers in the world, to put out something that says, look, this is why this is different. That's a pretty big stamp of not necessarily approval, but it gives it validity. It says like, this is something that needs to be considered. And so I think that things like that, and things like a little bit of legislation around this, some clarity from our regulators on how things are going to shake out with not just know your customer, the KYC, but also how are things going to settle properly, and what are the tax implications of these things, and how are they treated, as whether they're commodities or they're securities, or how are they going to be classified. And once we have that, that gives institutional investors a whole lot more ground to stand on. And remember that 98% of them are only thinking first, what's my fiduciary duty? And then I can go from there. And if I don't understand, if I can't have clarity from what this thing actually is, well, then it opens me up to litigation from my investors if I don't understand it well enough. So that's kind of where we're at right now. And that's from the institutional world.
In terms of correlation, like how do you think Bitcoin will behave relative to other assets? Or some of these correlations will increase, and like how will Bitcoin evolve as in terms of like how people will think of Bitcoin in their portfolio?
No, that's a good question. I don't think that the correlation will increase. It will decrease in my mind. And there's a number of reasons around that. But the first thing is, we talked about just a few seconds ago, was, look, the people who are interested in this space, in the institutions, they're from the technology side. Like, they look at this as technology. The technology analysts are the ones who are analyzing it. The ones who understand cryptography and cryptocurrency implications and how it all fits into the space. But once that kind of bleeds over and really moves into the financial world, and people start looking at this as it's digital money, I think that's where it starts to differentiate itself. But the big break will be when people understand that it's a store of value. Now, how do we get there, right? So the question is, like, what is it going to take for Bitcoin to be, in particular, to be seen as a store of value? And I think it's going to take the asset to have enough market value and liquidity that the volatility dampens. And it's going to happen in steps, right? So it's going to take a few very, very large institutional investors to start buying Bitcoin, right? And not just buying it, but then also announcing that they've bought it, right? So you've got 5 firms. We talked about this before. We've got 5 firms that control $30 trillion of investment assets in the world. So if you figure that there's about $700 trillion in total investment assets, $730 trillion in investment assets, that's a lot. 30 trillion out of 720. So, but 5 of those firms, you got BlackRock, Vanguard, Fidelity, State Street, and Morgan Stanley. And if any of those firms start announcing that they've really taken this and considered a separate asset, and we know that, we talked about Fidelity, we know that they're doing something. BlackRock, of course, is doing something. But when Vanguard comes out, when Morgan Stanley comes out and says, we are putting this in our portfolios, that's going to be a big deal. So, and once they do that and they start buying it, then you're going to get a lot of other investment managers that feel like they've got to do this. So it takes time, but we'll come back to that in a second. But once they start buying this and they decide they want to have a 1% position in this, well, then Bitcoin, a 1% position in all assets, right? So if you look at all portfolios and across all asset classes, between bonds, investable bonds, corporate bonds, sovereign bonds, you've got stocks, you've got real estate, you've got art and collectibles, and you've got gold and silver and metals. So, but if you put all of that in a basket in one big portfolio, and you say that 1% of that has to be the separate asset class, well, then you're already at a $350 million Bitcoin, $350,000 Bitcoin. Sorry, don't want to get everybody too excited. So, but $350,000 Bitcoin, okay, now you're talking about a $7 trillion asset, right? You get that up to 2%, and you're talking about over a $10 trillion, $14 trillion asset. Now you really do have the ability to put money in this and not see that same volatility. It's just not going to move the same way as it does here as such a small asset. I mean, we're not even $500 billion anymore. So, but once you have that, then I think that it really takes off. And I don't know where that breaking point is, but it's somewhere before that store value recognition that it just becomes completely uncorrelated. So maybe somewhere between $100,000 and $200,000 Bitcoin, where it rips up and it just completely decorrelates to the rest of the market. That's kind of the way I'm seeing it. That was a long answer. Sorry.
No, that was awesome. No, that was super enlightening. What do you think about like the DeFi space in terms of, I think there's a lot of questions around how to value these things. Are they decentralized? But at the same time, I think, whether, and again, I know you're, one of these, you're very Bitcoin centric on Twitter and when you're, talking in public and things like that. So, but I'm just curious from the perspective of this type of individual that we're talking about. Do you think that they'll basket in these other, digital assets with Bitcoin, or do you think they view these things as more of kind of quasi digital businesses, while Bitcoin is more of a commodity? Like, how do you kind of think they'll approach the two, or will they just view them, basket them together?
No, I think that's exactly what's going to happen, is that once Bitcoin becomes recognized as a commodity, then that's when it kind of breaks off from the rest of the pack. But that's going to take a little bit. There's so much misunderstanding still. I mean, you can see it in the mainstream media every single day. I mean, look at the coins that they have listed on CNBC and Bloomberg. I mean, it's embarrassing that some of the stuff that they list up there. But so once the institutions do recognize that, then it really does break off from that pack. Right now, the people I talk to, they're like, oh yeah, we own crypto, we own Ethereum and Bitcoin. And it's, it's like, you want to just kind of shake them and say, you've got to do some reading, man. You've got to really like understand the difference. And so,
you think people are just indexing, right? They just look at the top 3 or 5 and they just say, hey, look, I'll take a weighted position in the top 5.
Yeah, that's not an uncommon thing to do, Will, is to say, okay, I know that there's something here. Okay, so let's say we're talking here that Bitcoin's at $20,000. I know that there are institutions sniffing around here for real now. And whether or not they're big hedge funds or some of the smaller either endowment or pension funds, they're looking at this and saying, okay, we've got to at least take a little bite here, and then we'll figure it out along the way. And when you do that, you're not really sure what you're doing, right? So you buy a little bit of Bitcoin, you buy a little bit of Ethereum, you buy a little bit of whatever else, and you start doing your research and really digging in, and then you reweight them, right? So if I knew, you get this spidey sense, right? When you're in investing for a long time, you think there's something here. I sense it. I've heard enough that my subconscious is definitely analyzing this, and I feel there's something I need to be doing here. So I'm going to take a 1% position, and then I'll start doing, or a 0.5% position, something, and then I'll start really doing the work. Because if I take that position, I'm going to have to do the work. I can't just take the position and hope. So once I take it, then I'll do the work. It's not going to impact my portfolio terribly negatively if I did the wrong thing, because I'll be able to get out. So even if I lost 20% on a 0.5% position, that's 10 basis points for the whole portfolio. No big deal. But I'm not going to want to lose it. I'm going to want to do some work. So let's figure out where we are. And that's kind of that's really kind of where we're at, to be truthful, for a lot of these guys.
For sure. Let's pivot over to some macro stuff. I know, one of the things you did while you're in the traditional space is you dealt with, currencies, obviously, as you mentioned. For me, I was born in 2002. I always thought of the euro as being worth more than the dollar. And it's been really strange over the last week to see the euro actually go below the value of the dollar. Can we, I don't even really know where to start with this stuff. I mean, I want to just get your thoughts on everything going on with the euro and the yen. I mean, it's just absolute insanity, at least relative to anything I've personally ever seen in my short investment career. So I guess we start with the euro and then go to the yen, or wherever you want to go with it.
No, the euro it's kind of mind-boggling, right? So there are structural problems with Europe, right? So they've got this southern belt of countries that Greece and Italy and Spain and Portugal, that they don't have great balance sheets, right? So they have a lot more debt than they have GDP, right? So but they're in this collection of countries that have all agreed to use this central bank. And so the central bank is setting their rates. Okay, so you've got the central bank setting their rates. Meanwhile, they're actually not doing anything, right? So you've got this inflation that's just completely out of control there. 8.6% was their last print, which is a record out there. And so, but the problem is, they haven't raised rates in 11 years, and their key rate is still negative. It's negative 50 basis points, negative 0.5% still, even though inflation is going up and up and up, and they're just sitting there and they haven't done anything. Now they claim they're going to raise rates next week. I don't know how much they're going to do, maybe 50 basis points. I don't know, but they need to do something fast. But the problem is that once you have that inflation print, well, then everybody starts realizing, oh God, they're going to have to raise rates out in Europe. They're not going to have a choice, right? So who's going to be in trouble if that happens? Well, of course, the worst balance sheets are in Italy and Greece, and the Italian bonds just took off. The rates on the Italian 10-year, they spiked over 4% and then over 3.5% in Greece. And so traders are worried that will then spark problems within the banking community of those countries, which eventually leads to contagion and problems with the sovereigns, right? So those countries' debt. So the issue is that they're stuck. They can't raise rates too much, right? But they have to raise them in order to kind of clamp down on the demand issue. But they're having a massive supply issue out there with energy costs, and not even be able to supply energy. Apparently this winter, there's going to be some major problems there. But their solution is print more money. They're going to do yield curve control on certain bonds within certain countries. So they haven't done this before, where they're just like, okay, well, we're going to buy the 10-year, they've called this a fragmentation tool. It came out a few weeks ago, and they said, we have this new tool. It's called the fragmentation tool. It's a measure that we can use in order to make sure that we are standing behind, and we'll do all that we can do to support all the countries that are part of our union. Okay, well, what they're doing is called yield curve control, where they're cherry picking certain maturities and saying that we're going to support this maturity of this country. And the one that is obvious is the 10-year in the 10-year treasury in Italy. And so immediately after the 10-year spiked, as soon as they said that, it came back down, because people are like, okay, it's going to be okay, because the ECB is going to support Italy. And so they're in trouble. So what happens then? Then the Central Bank of Europe is buying those bonds, and it gets put on Europe, the European Union's balance sheet, and then everybody has to pay for it. But you're paying for countries that don't have great policy, right? So they're not going to have austerity like they ought to or need to, in order to pay for that, in order to get their debt and GDP aligned with their own country. And so who has to pay for it? Well, the northern countries have to pay for it. And eventually there's going to be enough frustration and anger from the north that they're paying for policy that's troubling in the south, and they're not going to want to have to take on this debt as a union. And so the question is, do they force them to reprice their debt, or do they or they actually push them out of the union, but eventually something breaks. I don't know when it happens and how long it takes, but this is just not a good path to go down.
What do you think about the yen as well? I know they've implemented yield curve control. I remember looking briefly one day, and the yield had spiked up to like, I think it spiked up like 25 bips or something, and then they came back in and bought it back down. But it seems like they've basically chosen to sacrifice their currency for the stability of the bond market. Which is what yield curve control is. The yen is now below, I think it's below its 2000 lows. So I think it's the lowest it's been in like 25 years or something like that. What do you think, like how will that kind of play out?
Yeah, the thing is, okay, so it's the lowest it's been in 25 years. That's one thing. But the second thing is the pace it took to get there. I mean, it's happened in the last couple of months. It's been incredible how that the yen, for everybody who's watching and hasn't been following this, the yen it's a reverse quote. So as it goes higher, it means it's getting weaker, right? So it went from 115 up to 140 almost. It's at 138. It's kind of flirting with 140 now. The problem is it did it so quickly, right? And the reason is that we'll go back to what happened in Europe in a second here, but the reason is that as Japan has absolutely, they've declared they're going to buy every single 10-year treasury that is offered on the market to keep that yield of the 10-year at 0.25%, 25 basis points. So that's your yield curve control out there, where they're going to buy every single bond. It doesn't matter. And they have bought so many bonds in the last month and a half or 2 months, Will, that they now own over 50% of all JGBs, Japanese government bonds. The BOJ, the Bank of Japan, owns over half of their own bonds. It's just insanity. Like this is a new one. No other sovereign has done this yet. So now they own over half their bonds. And you're right, the yen is suffering. So why is that? Well, as people are selling, as investors sell the yen, or they sell their 10-year bonds or any other bond, and they're getting out of that Japanese treasury, well, they get yen in return for that, but they don't want to hold the yen. They know there's going to be pressure on it, so they sell the yen and buy dollars, because that's the flight to safety, right? And the trade is to sell your Japanese bonds, buy your US treasuries. Why? Because US treasuries are yielding 3% or close to it, 2.8 to 3%. And so if you're selling your bonds over here that are only yielding 0.25% and you're getting a better yield over here of almost 3%, of course, you're going to sell yen, buy dollars, buy US treasuries. And that's kind of the trade. And that's why there's so much pressure on the yen, because people are in search of both yield and safety, right? So the dollar is the safest currency out there. It's the largest economy in there, and the United States dollar will be the last to fail whenever that happens. But you're talking about something intraday, you just mentioned, where you could see the JGB yields, that 10-year yield, spike up to 40 or 50 basis points intraday. And honestly, that what's happening there is it's not that the Japanese government's having trouble keeping up with the trades. That's happening outside their open market window, their federal open market window, right? So those are after hours trading in our hours, right? So, and really what it is, it's hedge funds who are doing what's called a short swap position. They're going short the JGBs, they're shorting the bonds and long the yen, making the bet that eventually the Bank of Japan is going to have to back off and allow that 10-year to go from 25 basis points to 50 or 75 or even 1 full point, and just let the natural market move it to the right spot. And when that happens, well, then you're going to have that treasury, the 10-year, go up in yield and down in price, and the yen go up in price versus the dollar, because it's going to come back down from 140 or 138 down to 135 or below, because then the pressure is going to be taken off that currency. People are going to buy yen to buy the treasuries. and that's going to be the trade. And so that's what you're seeing happen off hours. When you see it spike intraday in our hours, that's what's going on. So
that makes sense. Do you think there's any likelihood that the Fed will ease up to essentially take off some of this pressure on what our allies and the countries that make up of the euro and Japan as well? And kind
every
of,
man for himself, man. Every man for himself. No, I don't think that the Fed is really considering that. And I think with the, if we go back to the Bank of Japan, you've heard me say this before, I think they're just playing a game of chicken with the Fed and thinking, well, look, they're going to have to stop raising rates here at some point in the near future, because the data that's coming out is showing that we're either in or heading into a recession. And we don't have to go through all that data. It's all over the place. But knowing that at some point here in the near future, we're going to have to pull back. And if you just look at one of the things that it's easy to look at is the Eurodollar futures. And so if you look at Eurodollar futures, those are just deposits of their US deposits in foreign countries by foreign parties, right? And they're keyed off of the Fed interest rate. So one of the things that'll show is that when that turns and those yields start coming back down, it shows that the expectation is for the Fed to stop raising rates. And right now it's showing that somewhere between December and March, that's when we roll back over. Okay, so Japan is thinking, if we can just hold out through the end of this year, then we'll have won the battle, and pressure will come off the yen, pressure will come off of our treasuries, and because the US Treasury rate will come back down, and that push for yield will ease a little bit. So that's kind of what they're thinking over there, I think. So, but that kind of answered your question a little bit. When do I think the Fed's going to blink? Well, we're in an election year, and it's midterms in November, and I think that the Fed's going to want to declare that they've beat inflation at some point here in the near future, and that will allow them to pause. They're not going to immediately reverse, I don't think, and that would be shocking to me. But I think they'll raise again here, 75 basis points. Some people are saying a full point. I don't think that they'll do a full percent unless we get some really bad data here in the next in the next short while. I think that they'll still stick with that 75 basis points. And if they do want to raise it a full percent, they better start talking about it, because that would shock the market. You've seen what happened in the market. It immediately sold off thinking that, oh God, it's going to be a whole percent. And then some of the governors came out and kind of talked that down. So hopefully they don't do that. But I think that's their goal, is just to raise rates as quickly as they can ahead of this, and knowing that they have a short period of time here, because they're getting data in arrears. They realize that it's old data. They know that they're being reactionary. So that gives them a little bit of leeway. They know that too. And so they can raise rates really quickly and then pause. They say, okay, we've done it. We've tackled inflation. All's good. And then come take their foot off the brake a little bit. So when does that happen? I mean, Luke Roman thinks it's going to happen next month, and Luke is a super smart guy. He has been very, like, I've never heard a better talk than he gave at a Mark Moss event in Dallas a couple months ago. He's a smart guy. So I happen to think that they'll pause somewhere between August and October. I don't know when. And anybody who says they do, I mean, Luke's not saying he knows. He's thinking it, but these guys, they have their agenda. So,
hey James, the last thing I want to ask you before we wrap up here, we're coming up on an hour. When you wake up in the morning, what do you look at to kind of get your gauge on the market? I mean, I'm guessing you're, as a Bitcoiner, you're
I go
rolling over and checking the
straight
Bitcoin
to
trends.
your profile and I check every single thing you quote that you tweeted overnight because you guys stay up late, your kids.
Thanks.
No, I make my rounds. I want to see, being on the West Coast here. I don't wake up at 4 o'clock in the morning to make sure that I'm ready for the market. I'm not actively trading right now, so I can wake up and have the luxury of most of the information having already come out and being synthesized. So I will make my rounds between Larry Lepard and Luke Roman and Lynn Alden and and just start reading through what is going on. Of course, Zero Hedge has every single headline that's come out. I try to stay away from mainstream media as much as I can, but what I do is I will look through the charts that are coming out every single day of certain things, like the euro dollar spread, like where are these rates, where's the yen right now, and this stuff changes from day to day because one day we might have a CPI print, dig into that, or a PPI print, or one day we might have unemployment numbers. And so it's kind of the flavor of the day sometimes, but I will absolutely look at those charts. And the first thing that's easy to do is just pull up the Bitcoin chart to see. And it's not, hey, how much money have we made or lost? It's more of what may have happened overnight that caused this thing to move quite a bit, and then dig in from that perspective as well. So I don't know if that answers your question.
No, totally. I like the Twitter answer. I like to use my Twitter as a quasi Bloomberg terminal as well to get information.
Yeah.
So you just gotta clean your feed up a little bit of. So you gotta follow a couple funny people, but mostly great information.
Yeah, you need to have some of the shit posters in there. It's kind of funny. So and I'm laughing about it, but this has been a pretty stressful time for a lot of people. This has been super stressful. And even those people who are not in some of the protocols you're talking about, and some people who didn't get wiped out, that's been awful for a ton of people who got taken for their money, their savings. But this is super stressful right now, Will. And this is about as stressful as I've seen it for money managers, for portfolio managers in my 28 years. Like this is rough. There's a really difficult environment to figure out where to put money and actually get returns and get the right risk reward for it. So the levity is actually pretty welcome. And I can see it in the Twitter space. There's people are getting very short with each other. They're super quick to lash out, accuse each other of certain things. And I've seen fist fights break out on trading desks. This is not new. It's a different medium to voice your frustration and anger, but it's the same thing. And if you can keep your cool in this environment, you'll make it all the way through. And that's the hard thing to do, is keeping your cool, managing your emotions. Even though you may or may not have lost a lot of money at this time, we know it's not forever. Keep your cool, stay, just keep focused, know what you believe in and where your conviction is, and keep with that. So yeah.
James, I was going to ask you for final words, but that was better than anything that I think I could have asked you. So that was great. Where can we send people to find you, your Twitter and anything else that you want to link? I think you have a newsletter as well, right?
I do, yeah. So my Twitter is just James Lavish, and I have a newsletter that's called The Informationist, and that comes out every Sunday. And I just take one of these complicated subjects and boil it down for everyday language, super easy, simple, a few minute read. I've done things on the foreign exchange, repos, credit default swaps, whatever it is, just one topic, kind of where it is today and why it matters. And it's really easy. And that you can find in my bio. And then the other thing is I've been helping out this educational platform, Will. It's called the Looking Glass educational platform, and that's also in my Twitter bio. And for anybody who wants to learn more about Bitcoin and really about money and understanding the system and how it works, the kind of the history of it, again, super easy. It's like you sign up and it's all free, and you just sign up and you can go through these modules, kind of like a course. It's really awesome, and it's great for young people. It's great for people who are not in the industry, who are not in the financial industry, doctors or attorneys or firefighters or whoever it may be that is interested in really understanding the system. It's a great way to do it. You do it in your own pace, and then there are articles that'll link to other things, and you go down the rabbit hole. It's called the Looking Glass. So, and that's it. But
awesome. Yeah, everyone be sure to check those things out. I'm definitely going to subscribe to your newsletter if we hop off of here. But James, this has been a blast. I learned a lot. Very, very rarely do I go back and listen through the whole podcast again after we recorded, but this will be one of the ones that I'll have to go back and re-listen to. So we appreciate your time, and hopefully we get you back on in maybe the back half of the year.
Yeah, awesome. I appreciate it too, Will. It's always a pleasure to speak with you, and looking forward to next time we can get together for as soon as you turn 21, a beer.
Yeah, so close but so far away. All right, take care, James.
All right.